Will an implosion of the derivatives market cause the next economic collapse? Do derivatives provide useful insurance, or are they a ticking economic time bomb? Famed long-term investor Warren Buffett once quipped that derivatives are financial weapons of mass destruction. But what are derivatives, how are they constructed, and are they a useful form of insurance, or an untenable risk? What is a derivative? A derivative, such as an option, a future, or an infamous mortgage-backed security, is a financial contract over a fixed period of time, whose value is tied to an underlying asset such as wheat, precious metals, or properties. These contracts can be bought and sold as assets on a balance sheet, resulting in profit or loss, without the investors actually having to own the underlying asset. Essentially, one party to a futures contract agrees to sell silver, cattle, or grain to a counterparty who agrees to buy the commodity at a specific future price on a specific future date. The first historical evidence of a derivative, according to Aristotle, is thought to be a contract for olives, although the rise of modern derivatives is credited to Edmund O'Connor, who used to trade in soybean futures, although the algorithms used today are highly complex. The simplest form of derivatives are known as forward contracts. From a positive perspective, derivatives serve to hedge risks for businesses, for instance, allowing a farmer to guarantee a future price for grain or seeds for the next season, to a whiskey distiller being able to secure a fixed price for barley for the coming cycle. Whether the actual price for silver or barley or cotton is higher or lower than the agreed futures contract, is a risk taken by traders who are prepared to bet that they can make a margin from the gamble. While option contracts are the simplest form of derivative investment, where their intrinsic value is tied to the value of the underlying security, options give the buyer of the risk the opportunity to buy, or sell, or even borrow the underlying security, in order to make a bet on the direction of its price movement. The first problem is that complex mathematics has infiltrated the world of derivatives to create a spectrum of complex and exotic financial instruments. These include options, swaps, futures, forward contracts, and collateralized debt obligations, or CDOs. Such complexity means that values and prices are determined by mathematical constructs and not by the laws of nature or even economics. Thus, they are not real-world values and are essentially amplified debt obligations. The second major issue is that the buyer of risk does not have to put all the money down on the derivative, because they have to option to buy later, with a view to reaping the full reward of a gainful bet many times over. For example, let's take an oil trader who buys 1,000 barrels of oil in June at a future date in September, believing that the price will increase substantially. He buys September contracts at $50 per barrel, as his intuition tells him that sanctions will drive the price of a barrel of oil up to $100. If he wins, he will earn a margin of $50,000 on the $50,000 worth of oil he bid for in June. However, to realize a $50,000 margin, he does not have to put down $50,000 in June. He only has to risk a small initial margin payment, which is typically only a few $1,000s for each contract. When the trade is closed, if the actual price is higher, the trader wins, and if it is lower, he loses. If he wins big, as he has amplified his bet by leveraging. But if oil decreases in value to say $20, he will be liable for the entirety of the loss of the bet of $30,000, a figure many times higher than his initial outlay. Of course, real market bets are usually measured in the millions. Therefore, a company can create exposure for a financial institution that is many times greater than its liquidity. So, if the market for a given commodity deteriorates rapidly, say, for example, if extreme weather or a cataclysmic event wipes out an entire crop, or if products are mispriced or missold, as happened with mortgage-backed securities, a single trader could wipe out an entire fund. This is also a risk for the counterparty who offers the initial credit, as if the gambling institution defaults on the amounts owned on a derivative transaction, they have to absorb the default. According to the Bank of International Settlements, the gross market value of all outstanding derivatives, summing positive and negative values, surged from $12.4 trillion at the close of 2021 to over $18 trillion by June of 2022. Any sudden unwinding of these positions, a so-called derivatives time bomb, would cause a total market meltdown, which would be far worse than the subprime mortgage failure which triggered the global financial crisis of 2008. Derivatives are a preferred instrument of investment funds which use them to hedge their bets. The first hedge fund to collapse as a result of sudden negative movements in its derivatives positions was Long-Term Capital Management in 1998, a fund that was founded with Nobel Prize-winning economists. Clearly complex does not necessarily equate to clever, and not all equations give you the right answer. This all goes to show that complex equations cannot be used to predict and mitigate all risks, especially when they enter the realm of nonlinear differential equations. For, if pricing and risks are nonlinear, or even amount to exponential processes, such as implosions, then so are their outcomes. Thus we can certainly predict a financial boom, though not of the gainful kind. Thank you for listening.